With that, I'd like to introduce Justin Rasmussen, who's going to give us a snapshot look at local investments.
First, I'd like to thank Bill and Pete for covering some of the fundamentals that are at play in our region. I'm going to switch to the other side of the equation. I'm going to talk about some investment matrix that are at play in our region. So, for the next 10 minutes, I have two goals. First, I'd like to change the way that we discuss commercial real estate investment in our area. Change is maybe a little bit of a strong word. More tweak. I'd like to tweak the conversation that we're having. And second, I would like to provide some more accurate metrics when discussing our market. So first, typically when we think of commercial real estate, we think of commercial real estate as one investment class with separate asset types. However, a more relevant way to view commercial real estate is to view it as a bifurcated investment, meaning that we have large commercial real estate on one side and small commercial real estate on the other side. Now let's look at what I mean by large commercial real estate. So only 20% of all commercial buildings in the U.S. are over 17,000 square feet. Now, these transactions tend to be large in nature at $2.5 million or above, and they comprise the largest portion of total dollars transacted within the commercial world. These buildings also account for 71% of the total commercial space. So this small portion of commercial real estate, 20%, dominates the majority of the commercial real estate market. So this leads to three things. One, of course, they receive the most press coverage. Now, this increased press coverage tends to skew the information that we receive about the commercial real estate market in general. So, unfortunately, for markets like ours, they don't provide an accurate standard of measurement for what's going on within our community. So let's look at small commercial markets. So 80% of all commercial buildings in the U.S. are under 17,000 square feet. And these transactions tend to be somewhat obscure because they're smaller, under 2.5 million, and they're not as socially relevant in the grand scheme of things. So what comprises small commercial real estate? Well, typically it's your neighborhood shopping centers, small offices, supermarkets, most multifamily and student housing. So these are the types of buildings that we interact with on a daily basis. They're the types of buildings that are really important to our communities. And we, when I say we, I mean Lewiston, Clarkston, Moscow, Pullman are definitely a small real estate market. And I said mostly because we do have several buildings, a large portion of buildings that are over that $2.5 million cap. However, those buildings transact infrequently to the degree that they really don't and shouldn't impact the metrics that we use to measure performance in our market. So now we're going to delve into some investment matrix for this most recent quarter. So we're going to look at sales volume, price, cap rate to the 10-year T-note, and cap rates in general. So what I'd like to do is just compare large markets to the smaller markets, and I think that you'll see doing so gives us a more meaningful set of metrics to discuss our market. So first, let's look at sales volume. So in large markets, in this last most recent quarter, the pace of transaction dropped for the first quarter of 2016. However, in the smaller markets, they maintained their upward momentum that we saw from last year. The total sales volume in large markets was $111 billion. In smaller markets, it was $51.6 billion. Now, in the larger markets, they experienced a 20% year-over-year decrease in their sales volume. For us, in the smaller markets, we actually saw an 8.5% year-over-year increase. So, as you can see here on this chart, these smaller markets are here in orange, large markets are in gray. So it took us longer to get back to where we were transacting at a reasonable volume. When I say reasonable based on historical averages. Whereas large markets saw a large increase, and then they've also started to see a steady drop-off, and then this represents the decline of 20% there. So let's discuss price. So despite declining volume in large commercial markets, prices continued to rise. In smaller markets, our prices continued their nice, steady climb. We've not had a real dramatic price inflation, but we've also not gone down. It's just been nice and steady. So prices gained in large commercial markets by 8.6%, and prices gained in small markets by 5.1%. Now, let's see if it's here. it looks like I got erased here when I transferred over, but there was a note here that in fact there is a price versus volume divergence in the large markets currently. So a lot of my contemporaries in the larger cities are fairly concerned because you're seeing the volume of transactions start to drop off, but prices are still gaining. And they're starting to be concerned that there might be a future price correction coming to help resolve that issue. So as you can see here, we're here in orange. We picked up really about fourth quarter of 2012 and started to move into positive territory, but it's been just kind of a nice, steady progression versus the larger markets, which saw a dramatic increase second quarter of 2010, and then have had more volatility within their price. So let's talk about the cap rate to the 10-year T-note. 10-year T-note is typically used as a measure of risk-free investment within the investing world. So within the large markets, the spread between the cap rate and the T-note is 490 basis points. Now, that's an indicator of a healthy investment market for commercial real estate. It's still producing returns well above what you could get out of a risk-free investment. So in smaller markets, we saw a spread of 540 basis points. So that's great for us. It indicates that in many instances, our commercial real estate is giving a better return than some of these large markets. So this has a little bit of an error here. The gray is actually the small market on this one, and the orange, if you can see the orange, is actually the larger market. So it's not, historically, it's not uncommon to get a higher return relative to the 10-year T-note in our smaller markets. So now let's move on to cap rates. So the average cap rate in the large commercial market currently sits at 6.7%, and that is a 30 basis point decline year over year. So a decline in the cap rate means that we're having an increase in sales prices. So that's, if you're a seller, that's a good thing. Maybe not so good if you're a buyer. So the lowest were in multifamily at 5.7%, and office in central business district only at 5.4%. Office in general in these larger markets is not performing nearly as well as it is in the central business district. So in a smaller market, our average cap rate is 7.2%, and we've actually seen a 57 basis points of compression year over year in our market. So the lowest cap rates are in multifamily at 6.9, followed by hotel at 7.1, and office and retail actually came in tied at 7.3. So as you can see here, cap rates within these small markets tend to be higher, with the exception of hotels. Now, a question I frequently get is, why is that? We appear to have a more stable local economies. Why are our cap rates higher? Well, from an investment perspective, there's more risk associated with the breadth or the lack of breadth in our employment base. They see us as a narrow employer, meaning we don't have enough employers to support the cap rates in the lower ranges. So when I look at evaluating a property, I'm using typically these higher cap rates to reflect the investment appetite that's currently out there. So, in conclusion, our area is primarily a small commercial real estate region, and using the correct metrics is going to help us not only evaluate our investments better and our investments performance better, but it's going to help us compare ourselves to like markets, so we can make an apples to apples comparison and not get caught up in some of the rhetoric and some of what's coming out of some of these larger markets. Thanks.
Well, that was fabulous. Thank you very much, Justin.